One of the great things about our industry is the opportunity to educate and correct misconceptions that our clients and prospects may have about what it is that we do for them. On today's episode, we've got Erik Bowman, and we are walking through client misconceptions about the markets, client misconceptions about working with a financial advisor, and then also how he answers those. You don't want to miss this episode. Let's jump right in.
Sure.
I was reading an article, and it's about 10 misconceptions about the stock market that clients have and how to address them.
Let's do it.
And we're not going to hit all 10. I just want to hit a couple. And I'm going to read them to you.
And I have one for you that I'd like you to make sure you review too.
All right, look at that. I'm going to add that. So I'm going to read one to you, and I want your take and then how you address it. If this comes up, if this article is maybe full of hooey.
Yeah, let's see. I'll let you know.
Or how you address this. If clients say this to you, and maybe your take on how you would respond to this. So here would be the client's misconception. Well, if equities have the highest historical return among asset classes, then why am I not 100% equity allocation, Erik?
Yeah.
Do you run into that?
I do run into it every now and then. It's not super common. I think most people intuitively know that there's problems with a roller coaster ride. You can't always be on a roller coaster. Every now and then you have to get off. But the segue or the kind of objection response that I use when I handle that one is, during the accumulation years when you're savings, I 100% agree. Like, you could almost, if you're in your 20s, 30s, 40s, even 50, early 50s, to be very risky is okay, because historical market cycles call it when does the market drop and for how long does it drop? Every 7 to 11 years, and it drops for maybe 9 months, then it comes back up. So not a big deal when you're accumulating. It actually is beneficial. A 30-year-old should be begging for the market to drop.
Average bull market, 2.6 years. Average bear market, 9.6. Who brought their facts?
Months, 9.6 months.
Right. Yes, thank you, months.
Yeah. So the component that they need to know now is, when you transition from accumulation to distribution, there's a brand new risk you've never been exposed to before called sequence of return risk. It's the mathematical opposite of dollar cost averaging. Dollar cost averaging works when you're putting money into the volatile market, but when you're taking money out, then you're forced to, because you need the income and you're pulling assets out in the low market, selling low. That has a detrimental effect on the brokerage account. We want to think differently and find out what rate of return you might need for a successful retirement plan, hopefully in like the 4 to 5% range. And then we're going to look to design a portfolio with the least risk possible to achieve that return with a high likelihood, so that we remove the volatility and reduce sequence of return risk.
Perfect. All right, let me read you another one.
Okay.
I like that. I don't know, Erik. Investing is about buying the right stocks and then just selling them. That's all investing really is. I could do this at home in my basement.
Yeah, well, I think it is a little bit more of allocation. Let's just talk about 2022 and see how well that strategy worked. Most people think, for example, that I should buy all of NVIDIA or Microsoft, for example.
Yeah.
And I actually take the opposite approach. I said, why don't we stay broadly diversified for the most part, S&P 500, NASDAQ exposure, and let's benefit from those 7 stocks that are dragging the whole index forward. But in the event something cyclical happens and those 7 stocks stop being the force that drags the index forward, and there's a broader rally, we're still in the same index and we can still move forward. So I don't like guessing. I want to be diversified so that we have the best chance of being exposed to whatever equities are going to be moving up.
I like it. Perfect. Okay, here's one. I don't know, Erik. Why should I sell some of my stocks when the market's going up? Why would I do that? That doesn't even make sense.
Maintaining risk tolerance. So if you're exposed to a certain stock basket and it has done very, very well, your exposure to stocks as a whole or in general will be higher in proportion to maybe your fixed income side of the house. And that means in the next market downturn, you're going to feel it more. So we're trying to prevent the roller coaster ride during the distribution phase, which means maintaining the rough percentage of equities to fixed income that we want, whether it's 60-40, 70-30, whatever it is. We need to maintain that within a plus or minus 5% range so that when we distribute money, we don't exhibit sequence of return risk in the same magnitude.
You run into that one?
Yeah, a little bit.
Nice. All right. Let me give you
I
one.
will say, here's one caveat on that. You get some people that bought Apple back in 1995,
Yeah.
and they have not sold any, and they went from buying $3,000 worth, and now it's worth $1 million. Apple got them to the dance. They're not selling their Apple. So you've got to be really careful about saying, we've got to sell all this Apple. It's like, no, you don't. As long as you're doing appropriate risk tolerance and they're acknowledging that they don't want to diversify, maybe they'll sell a little bit of it, but they're not going to sell all their Apple.
But how do you? So I want to go back on that. That's interesting. So that what I popped right into my head when you said that was Enron.
Mm-hmm.
And for those advisors that are younger, Enron is something that's a cautionary tale. You had employees, in particular of Enron, that in their 401k plan they were able to buy company stock.
Right.
And so you had people that had millions. They were darn near like 100% Enron. And to talk to that person, because the company was just killing it.
Yeah.
And to talk to that person about like, hey, you should diversify. I mean, a classic story of diversification. We should spread this out. And then what ends up happening? Enron goes belly up. It's a house of cards.
Yeah.
It was Madoff before Madoff. The whole kit caboodle.
We always let them know that diversification, we believe, is a more appropriate approach. But we're not going to try to force somebody to sell something that they're not going to sell. All you're going to do is lose a client.
Do you have them? So do you have them? This would be my hunch is that you don't have many clients that would fall in this category.
3.
This is very.
I have 3 clients with Apple you wouldn't believe.
Okay, but it sounds to me like they're. I don't want to ask you too detailed of a question, but I imagine they have other assets.
Not really.
All right, you're walking right down a
It's the largest portion of their portfolio by far.
Do you have do you have as a practice protection? Do you have them?
You're right. A disclosure. Emails are tracked, right? So I love sending emails that say, hey, here's our observation. Although we'd love diversification, we understand your point of view that this has been a stock that's performed for you. Let's make sure we keep an eye on it during our reviews. Let's always consider diversification as a strategy, and perhaps over the years we could X, Y, Z.
Yeah.
But document your thoughts so that you don't just caught blindsided like you told them to go all in on Apple.
Yeah, that would be bad. Do you ever run into situations? So I remember this from being in my stint in personal practice, where you have a client that has some stock positions that have emotional ties. Like
Absolutely.
Dad gave it to me, and you're just like, this thing is a dog.
Absolutely.
But I know that it means that much. Have you worked somebody out of that?
Yeah, if it's a small portion of the portfolio, I say, this is emotionally attached to you. I'd say we just keep it. You want to fight people on things that are emotionally attached to, you're going to lose clients.
Yeah.
And if it's a small portion of the portfolio and it doesn't impact things, so be it. Let them keep it. You just reallocate the other portfolio, acknowledging what we have over here, and keep it. Now, if it's 50% of the portfolio, you better have a lot of data, and you got to be careful how you deliver the message if you're really going to try to get them out of it. Usually you want to take a moderate approach where you're slowly divesting of it over long term. And we've had clients who have held on to it, and literally around 5-year point, they're like, okay, we can sell it. Happens naturally.
Nice. Oh, that's interesting. Nice little diversion here. Okay, maybe our last one, and then I'm curious about the one that you have.
Yeah.
I don't know, Erik. Bonds are boring, so I don't need them. I don't need bonds at all in my portfolio.
I agree. No, I'm just joking. Bonds are more complex than stocks, actually. I don't know that they're boring. They still might be boring, but they are very important and very complex. So we actually call that side of the, of a 60-40 portfolio, the 40% that most people call bonds, we call fixed income, because there's more than bonds in the fixed income toolbox. We use structured notes, money market fund right now. There are, of course, bonds, and there's a multitude of bonds. I would just say, we want to have some type of shock absorber on the allocation in the event the stock side of the house drops precipitously. But we have to also be careful of 2022 when interest rates went up at the same time, and then bonds lost as much as the S&P 500.
Yuck.
So they're not necessarily the big shock absorber everybody thinks about. So just considering how you might reallocate, because what happened with bonds in 2022, about minus 18%, if you look at AG, the aggregate bond index, it hasn't come back. Now, the S&P, by contrast, dropped 20-some% at its worst, and it's come back in spades and is higher than it was then. So bonds don't work on the same path as stocks do. They're not correlated necessarily. They're not anti-correlated to stocks. They kind of run their own course, it turns out. So you need to be really careful about pure bond exposure. We're still only 10% bonds, true bonds in our portfolios. The rest are other, I call them surrogates for fixed or other fixed income tools.
You ever run into something along those lines?
Not often, no. I don't hear that specific commentary. I just so no, I don't hear that. I really don't.
So we will chalk up of the ones that we went through. We did 4.
And we got one more, remember?
And we got one more. But from the article, it seems like they're batting maybe about 75%.
Yeah, so far.
Okay. Well, we'll stop. We'll leave the other ones. The other ones are kind of boring, to be honest with you.
Okay.
What I do like about what you said, though, bonds are boring. One, they're not. They're very hyper complex.
Hyper complex.
And then 2, it's fixed income. It's not bonds.
That's right.
It's much. That is a pool that maybe has a calm surface, but boy, that's deep. Right?
Yeah, there's a lot going on over there.
All right, let's hear yours.
I'll never forget this. Current client of mine. So if they end up listening to this, they may or may not remember. But at the end of a seminar, they came up to me and they said, Erik. So we don't need any help with our investments. We just have a Social Security question because we're in mutual funds, so we're safe. So literally people, most people, there are exceptions to this rule, but most people literally know nothing about what they're saying about their equity exposure. They thought because they're in a mutual fund that they were safe, and the definition of safe means I can't lose money. As we know, a mutual fund can consist of a basket of stocks, 100% stocks. It could be bonds. It could be commodities. It could be a mix. It could be a balanced 60-40 portfolio mutual fund. That there is zero risk reduction just by nature of you being in a mutual fund. In addition, internal expense ratios can increase the cost dramatically. And then second to that, if you're in a non-qualified account, mutual funds, high expense ratios, and unintended capital gains tax at the end of every year when they reallocate the portfolio, whether or not you sell a single share. As you can tell, we don't use mutual funds in our portfolios.
I have one more. That's a great one. Okay, so the last one. This is the one we're going to land this plane.
All right, land this plane.
Okay. I'm even circling it. I don't know, Erik, an advisor is just an order taker.
Yeah, an order taker. I would say, first of all, when you think about an investment advisor, maybe that's the case. But I'm a retirement planner. We work within 5 distinct categories: retirement investments, retirement income planning, retirement tax planning, retirement healthcare planning, and retirement legacy planning.
Bam.
The hard work is everything else. Creating a 60-40 investment portfolio, probably the simplest thing I do.
What about, have you run into somebody saying something along those lines?
Not really. I mean, they question the value of an investment advisor.
That's a better way, yeah.
Yeah, and the answer is I'm not an investment advisor. I do investment advising, but I'm not an investment advisor. And once we also talk about the unique tools we use in our portfolios, we really quickly differentiate from anything they can do in the retail space. We have option strategies, things like that.
Nice. All right. I tell you what. I think that's where we're going to end this episode.
Sounds good.
I think this is fun. If you want a copy of the article, hit me up in the comments. I'll send it to you, and you can run through the other. We hit 5 of them, plus a bonus one.
Yeah.
So there's 5 other ones here that you can take a look at and see what you think. Be happy to. I would love to see what people think about it. Erik,
yeah.
I just saw Erik glance down because he's wanting a copy.
I wanted
of the
to see that. I want to see number 9 and 10.
I'll let you see that. I'll let you see the rest of them. With that being said, thank you for being here.
Thank you.
Thank you for being here. If you get a chance, would love it if you'd like and subscribe. It makes that way you are always in the loop whenever we drop a new episode. Promotional considerations paid to Yeti. We are a sponsor of Yeti at this point. We're going to flip that around, Erik, at some point. But that being said, have a great rest of your day. We look forward to seeing you next episode.